So this time of year, I tend to get a lot of inquiries, people looking to level up their finances, wanting to find a financial advisor. And so let's say you've done your research online, you've looked through the advisor's website, and now you made the jump and you're ready to schedule that first introductory meeting. But what are you supposed to ask? Before you get into the details of how they manage your money, how they might review your financial life, here's a list of top 10 questions that you should ask up front. And one of them includes a trick question. And this will really help you get some clarity around how they do business so that you can make an informed decision. So let's get started. Number one, are you a fiduciary at all times in working with clients? The term fiduciary is somebody who's required by law to act in the best interest of their clients. The same standard of care applies if you're a CPA or an attorney. A fiduciary is someone who is required to disclose conflicts of interest. They provide transparency about costs, and they are supposed to do what's right by their clients. Unfortunately, though, the term advisor is unregulated and it can be a bit like the Wild West. It's oftentimes difficult to distinguish between someone who might be a financial coach, someone who educates, somebody who's an influencer, and somebody who's actually regulated and credentialed versus someone who provides advice to followers for fun. And to make matters worse, not everyone who claims to be a fiduciary is actually acting in a fiduciary capacity at all times. Here's one way that you can spot the difference. When I worked for another financial services company, it was very common practice for brokers to act as if they're playing charades, that they were putting on their fiduciary hat when they're giving clients investment advice, and then they would lift off their imaginary fiduciary hat and put it on their desk when they wanted to pitch a certain product that doesn't require that same fiduciary standard. And so what's the result? The advisor was selling the client on managed portfolios as an investment, and therefore they were required to act as a fiduciary when making those recommendations. Yet 10 minutes earlier, that advisor was suggesting the client buy an annuity that helped them meet their quarterly quota and their bonus. That's an example of not acting in a fiduciary capacity. I described this scenario so you can look out for it. Am I putting my fiduciary hat on and taking it off? That shouldn't be something that you have to change. So when you ask your advisor if they're acting as a fiduciary, be sure that that means 100% of the time. Otherwise, there may be certain products that they are incentivized to sell that do not qualify as meeting that same fiduciary standard of care. So my answer, the short answer, yes, I am a fiduciary 100% of the time. Next up, number two, how do you make money? And there's a very nuanced word I need you to listen for here. The answer you're looking for is fee only. There are so many different compensation models on how to pay for advice and for planning. And it broadly breaks down into really three categories: somebody who is fee only, somebody who is fee based, and somebody who is commissioned. A fee-only advisor means that the advisor or planner is only compensated by the fee that you pay directly to them. They do not receive any compensation from the investments that they're recommending to you. There's no incentive for them to pick one over the other. And that really removes that bias from having them recommend those funds that might incentivize them. And instead, they're able to recommend those that they believe would be the most cost-effective solution and most appropriate based on your goals and objectives that you are trying to achieve. Now, somebody who's fee-based, so the difference here is fee only versus fee-based, is that term means the advisor is compensated both by fees and likely commissions or other trails. And it's often confused with the word fee only. The difference is that they're acting in a broker in some capacity and as a fiduciary at other times. Just like that advisor that was removing their imaginary hat, this can create that bias that incentivizes the advisor to select certain products that provide additional compensation to them. The third is commissioned advice, and that is sold just like a salesperson would sell cars. When a person is incentivized to make money based on what you buy, it can create a conflict of interest. They position their products to fit your needs, regardless of other potentially more cost effective or better solutions that may exist out there. It may not be done with malicious intent, and often the salesperson genuinely believes that their solution would fit your needs, but it doesn't consider the entire universe of available solutions. Recommendations are based on their inventory. Just like a car salesperson, they're going to recommend the products or the cars that are on their lot. And this practice is so much more prevalent when you're buying insurance or annuities. If you're working with a financial advisor or financial planner who works for an insurance company, you can pretty much guarantee that all their recommendations will be insurance solutions. An important question to ask is how much they stand to make from the sale. It's an honest question that they should provide transparency for. A fee only advisor is not limited by inventory. Instead, a fee only advisor will direct you to the investments that best match your needs. So, my answer, I am a fee only advisor 100% of the time. The only way I make money is from the fee that you pay directly to me. I have no other incentives or quotas to make, and that's why I'm independent. And you can find the details of my fee schedule right on my website. The third question that's important to ask when you're interviewing for a financial advisor is, what certifications do you hold and what's your experience? There's no shortage of alphabet soup of certifications, designations, credentials, and licenses in the advisory world, which really confuses investors who are just trying to understand what they all mean and who's qualified. For example, a certified financial planner or CFP professional is required to complete college level coursework, covers a broad range of personal finance topics. They're required to maintain a high standard of ethical practice. They're required to complete continuing education hours to stay up to date on the latest regulatory changes that impact your finances. They have to pass a rigorous test. They also have to have several years of experience before having the authority to use that credentialed status. And it's really considered the gold standard of fiduciary advice. Currently, right now, only 20% of financial advisors are CFP professionals. Another designation you may come across is called the CFA, or Chartered Financial Analyst. It is a globally recognized postgraduate professional designation. It's one of the most respected investment designations in the world. And to use those marks, it requires completing a minimum of 3 years of additional coursework for each of the three levels that then have a rigorous exam that you have to pass before progressing on to the next level. It has one of the highest fail rates of any designation, but it provides an in-depth mastery of investments, portfolio management, and valuation. So this one's much more technical to the investment side. The CFP is much more technical on the personal finance side. Using these marks, it really exemplifies a high ethical standard and requires several years of experience before you may be able to use that designation. And then actually only 1.7% of financial advisors are CFA charter holders. And there may be other designations that might be similar or might be specific to a certain niche. When searching for your advisor, don't be afraid to ask about their experience and ask about those certifications. Those may be beneficial to your needs as the client. So in my case, my answer, I have the CFP and the CFA designations. I have earned an MBA with a finance concentration. Fewer than 1% of advisors have completed that rigorous coursework experience and ethical requirements to earn both of those designations. And in my case, I've been in the financial services industry for nearly 20 years. I work directly with clients about their investments, creating financial plans, and I've helped thousands of clients make that transition into retirement bliss to achieve their life goals. Now, number 4, this is the fourth question that you should be asking when interviewing financial advisors. Do you have any disclosures on your record? No, this answer should be straightforward. You can also review the advisor's experience on the SEC website. So my answer is certainly no. The fifth question you should be asking when interviewing a financial advisor is what services do you provide? And do you provide both financial planning and investment management? The reason this is important to ask is really understanding what your goals are and how you might work together. Are you looking for holistic guidance from a planner who can take a look at your entire financial life? Do you want someone to manage your investments? Some advisors only manage investments, but investments are just one piece of your financial life. It's important to look for an advisor who will evaluate all the aspects of your financial picture and covers a broad range of financial planning topics. That might include something like cash flow planning and debt management, reviewing your investments, your asset allocation, doing retirement plans, looking at your tax return, doing tax planning or tax analysis, reviewing your estate plan and making sure your documents are up to date, and also ensuring that your accounts are titled properly. Understanding your charitable giving plans and making recommendations around how you can best give and meet those goals. College planning, insurance evaluations, and then understanding risk, doing a risk analysis. Make certain the advisor that you are hiring will provide you with the financial planning tools and the techniques so that you are well equipped to see how those investments are going to fit into your life goals puzzle. So, in my case, we provide clients with ongoing financial planning and investment management services. We help you grow, build, and protect your financial future and empower you to design a life of freedom, fulfillment, and joy. The sixth question you should be asking when interviewing financial advisors is, do you require a specific minimum investment portfolio in order to work together? There are two reasons why this is an important question to ask. First, it really helps you understand if you're a good fit for the cost of services that they provide. But it also helps inform you where you might fall on the range of vying for that advisor's time. As a follow up, it would be important to know if the advisor also segments clients based on account values and what that would mean in your working relationship with the company. So, my answer, no, we don't have asset minimums. That's why we offer financial planning as a standalone service. You do not have to have amassed a sizable investment portfolio before seeking financial planning advice. Instead, we charge a minimum fee for the work we provide, and that's to ensure we are fairly compensated for our time, our services, and our expertise that we're providing in our journey together. We strongly believe in full transparency and that you should know what the cost is for our services from the beginning. And you can find all the details of our fee schedule on our website. We do not segment clients based on the size of their accounts. The seventh question that's important to ask when interviewing financial advisors is, what extra costs are involved in working together? Here's a rundown of common costs that are outside of advisory and planning fees. One example is fees that are inside exchange traded funds and mutual funds. Those funds have an expense ratio. This is the cost of running the fund, and that derives from the management, from the operations, from the regulatory oversight of the investment itself. Now, ETFs and index mutual funds have some of the lowest costs in the industry. They can be a really great option to give you broad diversification inexpensively. But actively managed funds, you should know, will make those expense ratios increase because you're paying for that active management, that extra research for the fund manager to oversee that fund and make their recommendations. There can also be transaction fees that are charged by certain fund companies for buying and selling their funds. There can be fees charged by the custodian for the trades or operational requests like wire transfers to a third party. And 401k plans offered through your employer may have additional administrative fees, which may or may not be offset by your employer. Annuities can have commissions that range from 1 to 10% of the total value of the contract. That may cover the cost of insurance, and some portion may go into the pocket of the salesperson as compensation. There may be additional costs involved in the investments you own, but the key is to make sure that these costs are fully disclosed, and you want to ensure that these costs are reasonable. So, in my answer, I would say we look to minimize those costs as much as possible and building out that diversified portfolio. We balance this need for low cost with the desire to ensure that your portfolio is structured appropriately. We do prefer using ETFs over more expensive options to keep those costs low and to optimize diversification and keep more profits in your hands. The eighth question you should ask when interviewing your financial advisor is, what is your investment philosophy? An investment philosophy is really a set of beliefs and principles that guide our investment decision making process. If you believe strongly in active management, like trading one stock to the next, while your advisor focuses more on a passive approach, then your core philosophies are not going to jive. If you prefer to follow trends that are gaining momentum, yet your advisor focuses only on blue chip dividend stocks, these fundamental differences in strategy will eventually lead to some disappointment. It's important to understand the general approach that your advisor is taking in managing that investment portfolio. And if you want to get specific, ask how they feel about certain companies, their style of investing, or even what types of investments they avoid. It will give you much more clarity on how your portfolio will be designed if you work together. I'll give you my answer. We believe that the markets are efficient and they reflect publicly available information. Therefore, active management through selecting individual stocks generally does not add consistent value over a long period of time. That frequent buying and selling can add more in taxes, fees, and loss opportunities through trying to time the market. We believe that the best way to achieve long-term financial success is through an appropriate asset allocation strategy. It aligns with your goals. We want to establish a regular investment regime for those wealth builders, periodic rebalancing, and diversification in a disciplined approach. We focus on those things that we can control. Our investment management principles, our goal is to align and strategize. We want to designate strategies by account to align your values and goals. We want to focus on low-cost diversification, minimizing those costs with low annual expense ratios, like using index funds where possible. We believe in growing, not chasing. We want to optimize long-term inflation-adjusted appreciation or income to really fit your goals and avoid chasing that past performance that usually leads to that unjustified portfolio risk. We are very tax focused. We want to minimize those taxes over the long term while maximizing your goals for financial success through tax efficient investments and tax planning. And overall, we want to keep things simple. Look for those opportunities to simplify your financial picture and alleviate those financial stressors of life. The ninth question you should ask when interviewing a financial advisor is, how often, in what ways, do you communicate with clients? Before moving forward, you should really learn more about their process, their communication methods, and how frequently you would be expected to meet them. For drafting and creating financial plans, there's generally a lot more communication at the onset of that relationship. Find out from the advisor how they like to communicate. Do they communicate by phone? Do they communicate by email? Do they do web conferences? Is everything done in person? And make sure that matches with what's convenient for you. How often will you meet and update your plan? How should you connect if you have a quick question? So my answer is, we communicate frequently in the first 3 months as we're setting up your initial financial plan. We're organizing your financial dashboard, and we're establishing your investment accounts if we're managing them on your behalf. We are 100% virtual, and we're based out of St. Pete, Florida. But that means we can work virtually with clients across the US. Our meetings are held via web conference, and communication for non-sensitive materials can be done via email. But you'll also gain access to your own financial planning dashboard. That's where we'll collaborate together, and you can upload important documents to your vault for us to share and or store for safekeeping. Details of that financial planning process can be found on our website. We recommend quarterly or semi-annual meetings to check in on the plan progress as your life journey changes and evolves. But we're always available to schedule a meeting or answer a question if something comes up before then. The 10th question you should ask when interviewing financial advisors is, will I work directly with you or with others? The most important element in cultivating that lifelong relationship with an advisor is the trust that you develop over time. However, when you're working with one individual and then experience a shift of being passed off to another, more junior advisor, that can really feeling like you have to repeat your story and start over from square one in building that rapport. So if you work with a new advisor, ensure to ask all of those same questions in this top 10 list. And it may also be valuable to find out how many clients they serve. And the higher number of clients, generally, the more focused that firm is on simply adding more assets than building relationships. So that can really be the difference between feeling like you're just another number versus receiving that personal attention you really deserve. And my answer, you'll work directly with me. Here's the bonus trick question you should ask when interviewing financial advisors. How much money will I make? There's no way to accurately predict with certainty how investments will perform in the future. Tread carefully how an advisor answers this question. If they believe they can deliver specific results, it's a warning sign that you should continue to interview other companies. The most honest answer here is I don't know. Asking these questions will provide you with greater transparency in how that advisor is compensated, if there's any conflicts of interest, and if they're acting in your best interest at all times, if their expertise matches your needs, and that their philosophy aligns with yours. Ultimately, it gives you a greater sense of trust with the person you are entrusting to your biggest financial resources.